This week, Amazon made a move that could rewire the entire AI power structure, committing a staggering $50 billion to a single partnership. But while the company bets big on artificial intelligence, some investors are getting nervous about the colossal price tag, especially after a legendary investor slashed his position. Is Amazon spending its way to dominance, or is this massive capital outlay a sign of trouble ahead? Welcome to Ticker Watch News for Amazon Week 9, 2026. This is the weekly report on the news and developments for Amazon. It was a volatile period for Amazon shareholders. After a month that saw the stock fall by nearly 12%, the past week brought a modest recovery of just under 3%, with the price hovering around the $210 mark. The market appears to be weighing the company's aggressive long-term strategy versus significant short-term spending pressures. This performance contrasts with the broader market, which has seen slight gains over the same period. The biggest headline of the week was Amazon's massive new partnership with AI developer OpenAI. Amazon has committed to investing $50 billion in the company behind ChatGPT. The deal makes Amazon Web Services the exclusive third-party cloud provider for OpenAI's enterprise platform, known as Frontier. As part of the agreement, OpenAI will use Amazon's own custom-designed Trainium AI chips and will spend an additional $100 billion on AWS cloud services over the next 8 years. This move is part of a much larger story: Amazon's colossal spending on AI infrastructure. The company confirmed it plans to spend around $200 billion in capital expenditures this year, a huge jump from last year. A significant portion is for AWS, including a new $12 billion data center campus announced in Northwest Louisiana. While the scale of spending has made some investors uneasy, the company points to a surging AWS backlog of $244 billion as evidence of demand. On the retail front, Amazon officially surpassed Walmart to become the largest U.S. company by annual revenue, a major milestone. The company is also doubling down on its grocery business. It announced plans to open more than 100 new Whole Foods Market stores and is launching a new megastore concept outside Chicago. The 225,000 square foot store will sell groceries and household essentials while also functioning as a distribution center for same-day deliveries. This comes as the company expands its same-day delivery services to new cities like Louisville. It wasn't all good news, however. The company is facing significant regulatory and legal pressure. In the United Kingdom, Amazon lost a bid to throw out 2 mass lawsuits valued up to £4 billion. The lawsuits allege that the company manipulates its buy box feature to its own advantage. A similar case is proceeding in California, where the state's attorney general is seeking a court order to halt what it calls unlawful retail price controls. And in a notable move from a major investor, Warren Buffett's Berkshire Hathaway disclosed that it slashed its Amazon position by 77% during the last quarter. Berkshire first invested in the company in 2019. Wall Street's reaction to Amazon's heavy spending has been mixed, creating a clear divide between short-term concerns and long-term optimism. Several analysts defended the company's strategy. Bank of America, for example, reiterated its buy rating with a $275 price target. Its analysts argue that in an environment where demand for AI computing outstrips supply, every dollar spent on data center capacity is a strong indicator of future revenue. This view is echoed by other firms like Wells Fargo and JP Morgan, which also maintain overweight ratings. However, the headline-grabbing $200 billion capital expenditure plan for 2026 has clearly spooked some investors. The main concern is the impact on free cash flow, which fell sharply in 2025. This pressure was reflected in the stock's performance, which has lagged the broader market this year. The news that Berkshire dramatically reduced its stake adds to this cautious sentiment. While one firm's move isn't a definitive signal, the exit of such a high-profile investor has certainly fueled the bearish side of the narrative. Overall, the tone from analysts is largely bullish on the long-term AI story, but the market itself remains hesitant, weighing the potential rewards against the very real costs. From a technical perspective, Amazon's stock chart is sending mixed signals. The daily chart shows some signs of momentum bottoming out, which could suggest that the recent selling pressure is easing. However, the weekly chart paints a more problematic picture. Key indicators show a slow sinking trend, suggesting that a sustained rebound may not be immediate. This technical setup points to a stock that may need some time to find a solid footing. Fundamentally, the narrative for Amazon is a tug-of-war between a powerful growth story and a significant risk profile. The growth case is centered on Amazon Web Services. AWS revenue accelerated to 24% in the last quarter, and its backlog of future contracts has swelled to $244 billion. The massive investments in AI, highlighted by the OpenAI partnership, are intended to secure long-term dominance in the cloud. On the other side is the risk narrative. The $200 billion spending plan is a massive outlay that is already cut into free cash flow. This, combined with growing regulatory pressure in both the US and Europe over its marketplace practices, presents a headwind for the company. Looking ahead, the key thing to watch is how the market continues to process Amazon's AI spending strategy. The central debate is whether investors will embrace the bull case that this spending directly translates to future revenue, or whether the bear case gains ground, with fears of a costly tech arms race in shrinking cash flow dominating sentiment. The bull scenario sees Amazon solidifying its lead in cloud and AI, with AWS growth continuing to impress. The bear case would see regulatory challenges mounting and the high capital expenditures failing to deliver quickly enough, putting further pressure on the stock. The most likely path forward is continued volatility as the market tries to balance Amazon's undeniable long-term potential against its very significant short-term costs and risks. Thank you for tuning in to Ticker Watch. The information in this podcast is for educational and informational purposes and does not constitute financial advice. Please consult with a qualified financial professional before making any investment decisions. We encourage you to subscribe, leave a review, and share this episode.